Stop what you're doing, because what just happened in the metals market is the kind of move that makes people either panic sell at the worst possible moment or finally realize the game they're playing. Silver didn't just dip, it didn't just wobble, it got kicked down a flight of stairs, bounced off the landing, and then, almost like nothing happened, started crawling back up while most people were still staring at their screens in disbelief. And here's the part that should bother you. The price collapse wasn't the weirdest thing. The weirdest thing was everything around it. The outages, the technical issues, the sudden rule changes, the oddly timed headlines, the way the market behaved like a crowded theater where someone yelled fire, and the doors didn't open for everyone at the same time. So in this video I'm going to walk you through what today's move might actually mean, what I think mattered, and what was just noise. And the one detail I cannot shake, because if I'm right, the next move could come fast, and it could come when most people least expect it. Now let's rewind the tape. I almost never do 2 updates in one day, but a day like this forces your hand. When the market does something that violent, you can't wait a week and pretend it was just a blip. You have to talk about it while the fingerprints are still fresh. Earlier today, silver was down so hard that even seasoned traders were doing double takes. Gold dropped too, not nearly as violently, but enough to rattle anyone who's been feeling unstoppable after the run-up. If you've been around markets long enough, you know big drops happen. But a drop that steep, that fast, in a market that's been acting like it has rocket fuel? That's not a normal day, and the timing matters. This all played out with the weekend approaching, with the clock ticking toward the point where futures go quiet and the market gets that eerie pause where price can't respond to new information the way it normally does. When you feel that countdown, the psychology changes. People start thinking, do I really want to hold this over the weekend? And that one thought alone can turn a dip into a waterfall. I watched it unfold in waves. First, the shockwave, straight down like somebody pulled a trapdoor. Then the scramble, people trying to hedge, people trying to exit, people trying to get cute. Then the silence, when you could almost feel liquidity disappear for a few moments. And then, finally, the bounce, sharp enough to make anyone who sold the bottom feel sick. And yet, by the time we got closer to the end of the session, silver started clawing back. Not a full recovery, not a clean V-shape, but the kind of bounce that tells you buyers didn't vanish, they were just waiting. Or they were forced to wait. That difference matters, and we're going to come back to it. First, zoom out with me for a second, because if you stare at a one-day chart, your brain turns into a drama machine. On a monthly view, this move looks like chaos, but it also looks like something markets do during major uptrends. They punish anyone who got too comfortable. If you told most people at the beginning of the month that silver would end the month meaningfully higher, they'd call that a win. The problem is, nobody likes the path it takes to get there. The path is the part that shakes you. And that's why the first big question is simple. Was today a signal that the run is over? Or was it a stress test that actually strengthens the next leg? Here's my take. The trend isn't dead just because the market threw a tantrum. Trend breaks have a specific smell. They don't usually come with, oops, our system is down, sprinkled on top. They come with follow-through, sustained selling, and a lack of real buying interest when price tries to bounce. Today didn't feel like that. Today felt like a shake the tree event. A brutal one, yes, but not the kind that ends a long cycle move. Now, I'm not telling you to ignore risk. I'm not telling you to pretend volatility is fun. I'm telling you to understand what volatility is designed to do. It separates conviction from leverage. That's it. It's a lever purge machine, and you could see it in real time because while paper positions were getting vaporized, physical demand didn't politely step aside. It showed up. You could feel it across the retail market. When prices get slammed, people who've been waiting on the sidelines suddenly stop talking and start clicking buy. And if you've ever tried to buy during a panic, you know the second half of that story. The price on your screen and the price you can actually get are not always the same thing. That gap is where the real story lives. I am going to give you a quick snapshot of what that looked like without naming any companies because it is not about advertising. It's about behavior. As the paper price dropped, some of the most common products, things regular people actually buy, started thinning out. Not everything, not instantly, but enough that you could tell there was real traffic. The items priced closest to the headline price were getting picked off first. Then the lower cost, smaller ticket items started moving. Then you saw the out-of-stock tags creeping in on popular categories. And here's the nuance people miss: that doesn't mean the world ran out of metal in one afternoon. It means the shelves that serve everyday buyers don't have infinite depth. Retail inventory is a layer cake. When volume suddenly spikes, the top layer goes fast, and then the sellers have to decide whether to restock immediately or wait for the dust to settle. That decision affects premiums, delivery times, and the mood of the whole market. That's a clue, because when the crowd buys the simple stuff during a crash, it tells you fear didn't erase interest. Fear just activated a different kind of buyer, the buyer who's been waiting for permission. Now let's talk technicals for a moment, because I know some of you love charts and some of you hate them. But either way, levels matter when emotion is running the room. When silver dropped, it didn't just wander randomly. It snapped down into a zone that, if you've been watching the structure, lines up with a deep retracement that often acts like a rubber band point in strong trends. In plain English, it hit an area where buyers who missed the move are willing to step in, and where sellers start getting nervous about pressing their luck. And I'll tell you what I was thinking in that moment. If that zone fails cleanly, the market can fall into open space. If it holds, the bounce can be violent, because everyone who sold late suddenly realizes they sold into a wall. That wall held, and when that level held, the bounce wasn't gentle. It was urgent. That urgency tells you someone was waiting to buy, and they weren't trying to be subtle. Now here's the cliffhanger. Was that someone regular buyers or forced buyers? Because those are two totally different outcomes for what comes next. If it was regular buying, the market may chop and rebuild. If it was forced buying, short covering, margin driven by ins, dealers hedging, then the rebound can be sharp, but it can also be followed by another wave of weirdness. So don't get hypnotized by the first bounce. Watch what happens after the weekend when liquidity returns and the machines wake back up. Now I want to pull back the curtain on something most people don't think about: how fast a normal market can become a vacuum. A lot of participants don't put in limit orders. They put in stops. They put in market orders. They put in algorithmic rules that basically say, if X happens, do Y. And when X happens all at once, everyone's system is screaming, do Y at the same time. That's how you get those candles that look like the chart fell through the floor. Then you have volatility targeting funds that automatically reduce exposure when volatility spikes. You have risk parity style portfolios that rebalance when correlations flip. You have market makers widening spreads because they can't trust the next print. None of that requires a villain. It requires a crowded room and one loud noise. And on top of that, you have options. When silver rips higher, call buying can force dealers to hedge by buying futures. That can accelerate the upside. But when the move reverses and those options lose sensitivity, the hedges can unwind, and that can accelerate the downside. It's like a rubber band that snaps both ways. So yes, it felt unprecedented, but the mechanics are very modern. It's a market built on speed, and speed amplifies everything. Speaking of speed, let's get into the part that made this day feel like a thriller: the glitches. When a major exchange says it delayed trading because of technical problems during one of the wildest weeks in commodities, you can accept that as bad luck once. But when you have watched multiple episodes over multiple cycles where technical issues show up exactly when prices are under extreme stress, you stop calling it luck and you start asking uncomfortable questions. Was it a system overload? Sure, that's plausible. Was it a risk control decision dressed up as a technical issue? Also plausible. Was it a genuine failure triggered by volume spikes and volatility? Yep, could be. But here's what's not plausible: that it doesn't matter. Because when trading access is interrupted, the market doesn't become fairer, it becomes more uneven. The big players with alternate channels, internal liquidity, and deeper access don't freeze the same way the average participant does. And that means if you were trying to hedge, exit, or enter during that window, you might have been playing a different game than someone with better pipes. And that is why you saw people asking why certain protections didn't kick in the way they do in other markets. In equities, you get circuit breakers. In futures, you have limits and halts depending on product and venue. But metals can feel like the Wild West when volatility spikes, especially when the market is fragmented across regions, contracts, and physical flows. Here's a little history because it matters. When a major metals venue halted trading during a notorious nickel mess not that long ago, it showed the world that exchanges will hit the brakes when disorder threatens the system. Whether you think that's protection or interference depends on which side of the trade you're on, but the lesson is the same. In extreme conditions, the rulebook becomes flexible. So when you hear technical issue, don't just hear computer problem. Hear stress test, hear risk containment, hear somebody is trying to stop a chain reaction. Now add another layer. When systems go down at an exchange, it can ripple into the whole pricing ecosystem because a lot of derivatives, references, and hedges tie back to those prints. It's not just some traders couldn't trade. It's that the price discovery mechanism itself gets a fog machine thrown on it, and fog is where the best deals happen for the people who can still see. The second coincidence was banking and payment services in a major hub experiencing interruptions around the same time. Maybe it's unrelated. Maybe it's just the modern world being held together by software and caffeine. But if you're watching a high volatility event and you see trading disruptions plus banking disruptions, you have to at least consider the possibility that stress in one area can spill into another. Let me be clear. I'm not claiming some movie-style mastermind is behind the keyboard. I'm saying stress reveals weak points. Volatility doesn't just break portfolios, it breaks infrastructure. And that takes us to the next question. Why did the smash happen when it did? The easy answer is because the market was overextended. And honestly, that's a big piece of it. When a market runs hard, fast and non-stop, leverage piles in, options get stacked, speculators get bold, stops get clustered, and then all it takes is one shove to trigger a cascade. But the deeper answer is that cascades are profitable for certain participants, because here's how it works in real life. A sharp drop forces liquidations. Liquidations push price lower, lower price triggers more stops, stops trigger more selling. And in the middle of that mess, someone with dry powder and patience can scoop up exposure at discounts that don't exist on calm days. It is like a clearance sale where the store plays scary music so people run out and leave the merchandise behind. Now I want to challenge one popular narrative right here, because this is where a lot of commentary goes off the rails. Some people see glitches and immediately jump to, the price was hacked. Could there be manipulation? Markets are manipulated all the time in small ways. Spoofing, stop runs, liquidity games, none of that is fantasy. But someone typed a number and changed the price is a big claim, and it often ignores a simpler explanation that's just as ugly. The rules of the market already allow aggressive players to create price air pockets without hacking anything. All you need is leverage, thin liquidity at the wrong moment, and a big enough push. So instead of assuming a magic backdoor, I focus on incentives and mechanics, and mechanically one of the most overlooked drivers on days like this is margin. When volatility spikes, clearing firms protect themselves by raising margin requirements. That means if you're holding futures, you suddenly need more collateral. If you don't have it, you're forced to reduce positions. That reduction looks like selling pressure, and it can happen even if you still believe in the trade. That's the key. You can be right and still get forced out. And once forced selling starts, it can spiral. So when you hear that margin requirements changed into the move, don't treat it like a side note. That can be gasoline. Now add a hot inflation print into the mix, something that shifts rate expectations, jolts the dollar and changes how funds allocate, and you've got the kind of cocktail that turns a crowded trade into a stampede. But the plot thickens because rate expectations also feed into the next storyline, central bank policy and leadership. There was chatter about the next central bank chair candidate being more hawkish, more disciplined, more willing to fight inflation, and the market loves to pretend that a new face means a new system. Let me ask you something. Do you actually believe a central bank chair is going to be the person who says, we're going to let the debt unwind naturally? Because if you do, I've got a bridge to sell you. The modern system is built on refinancing. It's built on rolling obligations. It's built on keeping the machine lubricated. When the machine starts grinding, policymakers don't reach for a philosophy book. They reach for the emergency toolkit. So even if a new chair talks stuff, the real question is, what happens when financial conditions tighten and something breaks? History says the answer is usually the same. Liquidity shows up. That's why I think part of today's move could be a misread. The market heard hawk and reacted as if that automatically means strong currency, weak metals. But metals aren't just a trade against rates. They're a trade against trust, and trust doesn't heal overnight because of one appointment rumor. Now let's pivot to the physical side again, because this is where the paper versus real conversation gets spicy. In the West, a lot of silver exposure is represented by products that people assume are backed one-to-one by metal. Some are structured tightly, some are looser, and some rely heavily on the idea that not everyone will ask for delivery at once. That's not necessarily fraud, that's just how financial products work, but it matters when the world is stressed, because during extreme moves, one common theme is that physical flows don't always match paper pricing. You can have paper price crash while physical premiums hold firm. Or you can have paper price spike while retail inventory disappears. The point is, paper tells you sentiment, physical tells you stress. Now there has been a persistent pattern in recent years where certain regional markets traded higher local prices due to demand, import constraints, currency effects, or simple scarcity. When those spreads widen, it creates incentives for arbitrage, moving metal from where it's cheap to where it's wanted. And if you want a plausible explanation for why someone might want the paper price lower, here it is. A lower paper price can reduce the acquisition cost of metal that's being sourced through financial channels, then redirected into physical demand centers. That doesn't require hacking, it requires plumbing. So if you saw a big divergence between overseas pricing and Western pricing, don't ignore it. That divergence is a map of where metal wants to go. And now the question becomes, how long can that divergence exist before it snaps back? Because if the real clearing price is higher in a demand center and supply keeps draining, eventually one of two things happens. Either Western prices rise to close the gap, or Western inventories get stressed enough that the paper price becomes less meaningful. And that's where things get explosive. Now here's another cliffhanger. What if today's crash wasn't a sign of weakness, but a desperate attempt to create inventory at a lower cost? That's not guaranteed, but it's a scenario you should keep on the table. And if you're wondering, okay, so what do I do with that? I'm not here to tell you what to buy or sell. I'm here to help you understand the chessboard, because understanding the chessboard is how you avoid becoming someone else's liquidity. Let's talk about what I personally watched for during the chaos. 1. The speed of the drop. Fast drops are often liquidation events. 2. The behavior. Near key levels. Buyers showed up. 3. Retail physical behavior. Demand didn't vanish. 4. Infrastructure weirdness. Trading disruptions. 5. Narrative timing. Headlines lined up with the move, almost like the story was written in advance. And that last part is where I want you to be skeptical in a healthy way, because there's an entire ecosystem that profits when you feel emotional. Panic sells. Get clicks. It's over thumbnails get views. And in the middle of that, people can get pushed into decisions they regret. Which is why I'm going to ask you a question right now, and I want you to answer it in the comments. Do you think today was mostly forced liquidation, or do you think it was a deliberate squeeze on leverage? Drop your take below. I read more of those comments than you probably think. Now, while we're talking comments, here's something I always want from this community. If you're successful, share your success story in the comments so others can stay motivated. Seriously, people need to see wins that came from discipline, not luck. Alright? Back to the storyline. If you're holding physical metal, days like today don't change your ounce count, they change the mood. That's it. But if you're holding leveraged paper exposure, days like today are a reminder that volatility isn't just a number on a chart. It's a margin call, a forced close, a broker email, an overnight gap, a weekend of stress, and that is why people who treat physical as savings and paper as a trade live into different emotional universes. Now, I also want to address the weekend effect because it matters. When markets close, you get a pause in price discovery, but you don't get a pause in world events, and you don't get a pause in how people feel. If a geopolitical headline breaks while futures are quiet, the first open can be violent. And that's why weekends can be uncomfortable in periods like this. There was talk circulating about potential military escalation in the Middle East, including the possibility of strikes. I'm not here to predict it. I'm here to tell you what markets typically do when fear spikes, energy jumps, safe havens catch bids, and liquidity gets weird. So if you wake up Monday and see a gap, don't be shocked. That's what risk does when it's repriced after a pause. And here's another angle that doesn't get enough airtime. Sometimes the simplest explanation is the right one. Big funds had profits on the table from the run-up. A surprise inflation print can force a rapid rotation. A volatility spike can trigger de-risking. Combine profit-taking with margin hikes, and you can get a waterfall without any secret plot. I keep that skeptical lens on so I don't turn every move into mythology. But even if it was just mechanics, the consequence is still the same. The market just showed you where the tripwires are. It showed you that liquidity can vanish, and it showed you how quickly sentiment can flip. The people who survive are the ones who plan for chaos instead of assuming calm. So when Monday opens, pay attention to the first hour. Does price snap higher and hold? That suggests selling pressure was exhausted. Does it pop and fade? That suggests the market is still cleaning itself out. Either way, don't judge the whole week by the first headline you read. Now let's build the timeline forward. What happens next week depends on whether today's move cleared the leverage out or whether leverage is still hiding in the corners. If leverage is mostly flushed, the market can rebuild on sturdier footing. If leverage is still there, you can get a second wave, because the first wave just taught everyone where the pain points are. That's why I'm watching not just price, but positioning behavior, options activity, open interest patterns, and whether physical premiums react. Based on recently published numbers and recent market updates, the broader commodity complex has been dealing with heavy cross-currents, currency swings, shipping disruptions, inventory cycles, and shifting demand narratives. According to the latest publicly available filings in the sector, large funds can change exposure quickly when volatility spikes, and that kind of repositioning can echo through metals even when nothing fundamental changed overnight. Metals don't trade in isolation, they trade inside a messy world. And historically, when you get a violent shakeout in a secular move, it often marks a transition from easy trend to hard trend. Easy trend is when price goes up and everybody feels smart. Hard trend is when price goes up, but it tries to throw you off the ride first. Hard trend is where the gains are bigger and the mistakes are more expensive. Now, I promised you something earlier, the detail I can't shake. Here it is. When a market can fall that far and still find real buyers, it tells you demand is deeper than you think. We've seen metal manias before, we've seen blow-offs and reversals, we've seen the market change rules midstream, we've seen speculators get carried out. Those were different eras, different structures, different market participants. Today's market has its own unique ingredients: industrial demand tied to electrification, tighter just-in-time, inventory practices, financialization through ETFs and derivatives, and a global tug-of-war for strategic materials. So when silver moves, it's not just a metal moving, it's an input moving, it's a currency alternative moving, it's a stress indicator moving. And if you think that doesn't matter, ask yourself why the headlines get so loud whenever silver gets exciting. Now let's talk about the retail behavior we saw, because it's not just anecdotal. When prices drop hard, you often see a surge in fractional purchases. People want exposure, but they don't want to commit a massive ticket. That's why small denomination products can sell out first. It's not always everyone is buying. Sometimes it's everyone is buying a little, and that's still meaningful because it shows persistent interest. Also, watch the behavior of pre-owned and older coin markets. Those markets can act like a pressure gauge. When those items get cleared quickly, it can signal that buyers are not just chasing price, they're chasing availability. Now I'm going to say something that might annoy some people. Not every outage is a conspiracy. Sometimes systems genuinely fail, but here's the uncomfortable truth. Even if the outage is unintentional, the impact can still advantage certain players. Intent doesn't change outcome. If you couldn't trade when you needed to, you suffered. Someone else benefited, even if they didn't cause it. That's why I don't spend my time making cinematic claims. I spend my time asking, who benefits from this outcome? And on days like today, the beneficiaries are usually the ones who can buy when others can't, and the ones who can survive margin increases without blinking. Now, here's another engagement question for you, and I want real answers. If you had to guess, what was the single biggest driver today? Margin changes, macro rates, exchange disruptions, or a deliberate stop run? Pick one and explain why. Alright, I also need to mention something practical. The description has bonus links, including a premium WhatsApp channel link and a channel membership join link. If you want the extra updates and the behind-the-scenes stuff, those are sitting there. And speaking of membership, we do offer members-only videos produced by a separate team that goes deeper with more research and more context. Those videos are only for premium members, and they're built for people who want more than surface-level commentary. Now let's address the AI content problem, because it's not a side issue anymore. In the last year, the internet has been flooded with auto-generated market updates that sound confident and say nothing, or worse, confidently say things that never happened. The scary part is not that it exists. The scary part is that in a fast-moving event, a fake narrative can spread faster than a real one, and there was a perfect example of that, a clip floating around that claimed the market had already crashed to a specific level before it happened, like it was prophetic. But when you actually compare the details, it doesn't line up cleanly. It's more like a broken clock moment. Publish enough guesses, and one will look eerie in hindsight. So here's my PSA, don't outsource your brain. You say AI as a tool if you want, but don't let it be your compass. Because on days like today, your biggest enemy isn't the chart, it's the impulse. Now let's tie the whole story together. We had a market that ran hot, leverage piled in, a catalyst stack formed, macro data, policy chatter, margin dynamics. Then price got slammed into a zone where liquidation snowballed. Along the way, critical systems wobbled, retail buying showed up in pockets. Price bounced off a deep level, suggesting demand still exists. Meanwhile, the narrative machine tried to frame it as either the end of the world or a nothing burger. My view is in the middle. This was a warning shot. A warning shot that the ride up is not going to be smooth. A warning shot that if you're playing with leverage, the market can humble you in one afternoon. A warning shot that when volatility hits, access and infrastructure matter more than most people admit. And a warning shot that there may be structural reasons why paper pricing can get stressed while physical demand stays sticky. So what am I watching next? I'm watching whether price can hold above the bounce zone into the next full trading week. I'm watching whether the next rally gets sold immediately or whether sellers look exhausted. I'm watching the behavior of spreads and premiums. I'm watching whether we get more technical issues conveniently timed, and I am watching how people talk about silver after this, because sentiment swings are part of the game. When everyone is euphoric, the market punishes euphoria. When everyone is terrified, the market punishes fear. The winners are usually the ones who can stay boring while the market gets dramatic. Now, one more cliffhanger before we wrap. If the people who got shaken out today try to chase back in next week, that demand can fuel the rebound. But if the people who bought the dip get rewarded quickly, it can create a new wave of confidence, which sets up the next shakeout. That's the cycle. So don't confuse a bounce with safety, and don't confuse a crash with the end. Now, if you want me to keep covering these kinds of market events in real time, make sure you're subscribed and drop a comment so the algorithm knows you're here. The next move could be quieter, or it could be louder, and the market rarely sends you a calendar invite. Alright, last thing, no matter what you believe about today, whether it was pure mechanics, pure fear, or something more strategic, remember this: your plan matters more than your opinion. If you're investing, define your horizon. If you're trading, define your risk. If you're stacking, define your purpose. Because price will do whatever it wants, but you don't have to do whatever price wants. If you nail a plan and it actually helps you, come back and tell the story. If you're successful, share your success story in the comments so others can stay motivated. That kind of feedback loop is how this community gets stronger. Thanks for watching. Stay sharp, stay patient, and I'll see you in the next one. And just so it's clear, everything you heard here is for educational purposes and general discussion. I'm not your financial advisor. I don't know your situation, and nothing in this video should be treated like a personal recommendation. Do your own homework and make decisions you can live with.